Hello friends, welcome to Study Center. In today's video of banking awareness, we will discuss about bank. We all know what a bank is, but I think very few of us know the definition of a bank. Sadly, the term bank has no direct definition. Instead, the term banking has a definition. As per Section 5B of the Banking Regulation Act 1949, banking means the accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise. From the definition, it is clear that bank gave more priority to accepting of deposit than comes lending. As per Section 5C of the Banking Regulation Act 1949, a banking company is a company which is into banking activities. So what we call a bank is actually a banking company. As I've said earlier, there is no direct definition of bank in the Banking Regulation Act 1949. All the banks which are listed in the second schedule of the RBI Act 1934 are called the scheduled bank. The scheduled bank can be divided in two parts: scheduled commercial bank and scheduled cooperative bank. In this video, we will discuss about scheduled commercial bank. These are the commercial banks which are included in the second schedule of the RBI Act 1934. The scheduled commercial bank consists of public sector bank, which includes SBI, IBPS, and all the nationalized banks, private banks, foreign banks, and the regional rural banks. So what is a public sector bank? PSB are banks where a majority of stake, that is more than 50%, is held by the government. The share of these banks are listed in stock exchange. There are total 21 PSBs in India as of now, including 19 nationalized banks, SBI and IBPS. Before understanding what a nationalized bank, let us first know what is nationalization as a process. So nationalization is a process whereby a national government or state government takes over private industry organization or assets into public ownership by an act, ordinance, or some other kind of orders. In simple word, nationalization is converting private properties into public. The main objective of government behind nationalization was to provide banking services to unbanked area, to the people who needs it. Before nationalization, the banking services were concentrated to a particular locality and a community. Government issued an ordinance and nationalized 14 largest commercial banks in India from the midnight of 19th July 1969. In 1980, the government again nationalized 6 more banks. So after 1980, there were 20 nationalized banks. In 1993, the new Bank of India merged with PNB, so left with 19 nationalized banks after 1993. Now let's come to foreign banks. Foreign banks are the banks which have headquarters outside of India. They follow all the banking regulation of both the home and the host country. Now comes the RRB or the Regional Rural Bank. They have been created with a view to serve primarily the rural area of India with basic banking and financial services, which means they are primarily located in the rural areas. They can also be found in some urban areas. Regional rural banks offer local banking services in different states of India, established in 1975 under the RRB Act 1976. Because even after nationalization, banking services were not completely available to the rural areas. Each RRB is owned by 3 different entities with their respective shares as follows. Central government has 50% of share, state government has 15% of share, and sponsor bank has 35% of share. Well, that's all for this video. Hope you have learned something from this video. If yes, then do hit the like button and share this. Subscribe to the channel and hit the bell icon to get notification when the new video is uploaded. See you in the next video, guys, and thank you again for watching.